Respected viewers, I want to begin with a simple yet profound question. Why do we keep our cash in the bank? Now, I know some of you may be thinking, it's the safest place to keep money, right? After all, the bank is secure, it's insured, and it gives you easy access whenever you need it. That's what we've been told for generations. The idea is simple. Put your money in the bank, and it will be safe, it will grow, and you'll always have access to it when you need it. It's easy, it's familiar, and it feels comforting. But what if I told you that the idea of keeping your money in the bank is actually one of the most costly financial mistakes you could make? Let's take a closer look. We've all heard of IDly savings accounts. They're the default choice for most people when they start building their wealth. But here's a shocking reality that most people don't grasp. As while your money is sitting in the bank, it is silently losing its value. How, you ask? Well, consider this as inflation. Inflation is a hidden thief that steals your money's purchasing power over time. And here's the cold, hard truth. The bank does not protect you from inflation. When you keep your money in a savings account, you're allowing inflation to slowly eat away at the value of that money. Think about it for a moment. Imagine you have $100,000 in a savings account. Now, let's say that inflation is running at about 3% per year, which is common, though it can be much higher at times. That means that the value of your money is losing 3% of its purchasing power every year. In practical terms, this means that after 1 year, your $100,000 would only be worth $1,097 in real terms because inflation has reduced its value by $3,000. So what does this mean? It means that while your money may be sitting there in the bank, it's actually working against you. Even though your bank statement might show an extra $100 in interest, the other's purchasing power of that money has decreased over time. In real terms, that extra $100 is worth much less than it would have been last year. You may be asking, but why don't banks offer higher interest rates to offset inflation? The sad truth is that they do, but not enough. Even if you find a high-yield savings account offering 1% to 2% interest, inflation is still outpacing it. In this case, your money is still losing purchasing power. But that's not all. Let's look at the long-term consequences of this. Over as decades, if you continue to leave your money in the bank, inflation will eat away at your wealth. You may end up with the same nominal amount in your account, but it will buy you far less than it would today. If your wealth is not growing in line with or faster than inflation, you are essentially losing money over time. Here's a very real scenario. Imagine you're saving for retirement, relying on your savings to sustain you when you can no longer work. Over 30 years, that money in the bank might seem like it's growing, but in reality, it's losing ground to inflation. If you've been diligent and saved up a $500,000 by the time you retire, and inflation has averaged 3% annually, that $500,000 will be worth roughly $1,065 in terms of its purchasing power, a significant loss. This is the silent danger of leaving money in the bank. It feels safe, but it's far from safe in the long run. Wealth isn't just about putting money aside and hoping that it will grow. Wealth is about actively managing and growing your resources in ways that keep pace with or outpace inflation. And that's where the rich have a different understanding. The wealthy don't simply store their money in a savings account and let it sit there. They understand that as money needs to be invested in assets that can outgrow inflation and generate returns. When wealthy individuals accumulate wealth, they don't leave their money idle. They deploy it in assets that provide returns, such as stocks, as real estate, as business ventures, and other wealth-generating vehicles that not only preserve capital but grow it significantly. Take a moment and ask yourself, if keeping your money in the bank is so safe, why are the richest people on the planet consistently investing their money in other assets? The answer lies in something that wealthy individuals know and understand. Fair's inflation will always outpace bank interest rates, and if you are not actively investing your money, you're simply allowing your wealth to lose value. The idea that cash is king may feel good in the short term, but it doesn't stand up in the long term. To build real wealth, you have to make your money work for you. Dear family of dreamers, now that we've established the limitations of leaving your money in the bank, let's talk about an asset that has stood the test of time, one that the wealthy use to build lasting wealth as real estate. Real estate has a long history as one of the most consistent, reliable ways to build wealth. For decades, and even centuries, those who have understood the true power of real estate have created ours generational wealth. But why is it that this particular asset class has been so effective for the rich? Well, let's explore this in depth. When you invest in real estate, you're not just holding a piece of property, you're holding an as-income generating asset. Unlike a savings account or even stocks, real estate can generate consistent cash flow through rental income. This provides you with something that a savings account will never give you as passive income. Think about it: a rental property, whether it's a single-family home, a multi-unit complex, or even a commercial space, can provide a monthly cash flow. This means that your real estate investment is actually working for you, generating income on a monthly basis without you having to do anything. But there's more to it than just cash flow. One of the most powerful aspects of real estate is the ability to leverage your investments. With the right loan terms, you can control a large asset with a relatively small amount of capital. Let's say you purchase a property worth $500,000 and you only put down $100,000. The bank is essentially loaning you the remaining $400,000, and in return you can rent out that property, collect income, and also benefit from the property's appreciation over time. Now imagine if this property appreciates by just 5% annually. That's $125,000 in value added to your asset each year. Over time, the property's value continues to grow and your equity in it increases. But here's the real beauty. You're not just making money off the appreciation of the property. You're also making money off the rental income, all while using other people's money to increase your ownership. This is the concept of leverage. In real estate, you use borrowed money to buy an appreciating asset, and the property's rental income helps pay down the debt. This creates what is known as passive wealth generation, income that requires very little day-to-day effort. Real estate is also a hedge against inflation. Over time, as inflation rises, the cost of living increases, and so do rents. This means that as the price of goods and services rises, the income you generate from your rental properties tends to rise as well. This is crucial because it means your property is growing in value while the rent you charge increases to match inflation. Let me share a story that may shed light on the power of real estate. A few decades ago, there was a young man who purchased a modest property for $100,000. At the time, it was an average home in a middle-class neighborhood. Over the next 20 years, that property appreciated, and by the time he sold it, it was worth over $400. That's a four-fold increase. But what made his story even more remarkable was the rental income he received from that property during those 20 years. Each month, he collected rent as passive income and used that money to purchase even more properties. He didn't need to rely on a salary or the bank's low-interest savings. Instead, his investments were working for him, growing exponentially over time. This is the power of real estate investing. It allows you to leverage your money, generate passive income, and hedge against inflation, all while building long-term wealth. Now, some may argue that real estate requires a lot of work, repairs, tenants, and so on. But here's the thing. The wealthy know how to build systems that make this process efficient. They hire property managers to handle the day-to-day tasks, and they carefully select properties that will generate the most stable long-term returns. While it might take time and effort up front, the payoff is more than worth it. You don't need to have millions of dollars to invest in real estate. With the right strategy, even someone with modest means can start building a portfolio of rental properties. It's about leveraging other people's money, finding undervalued properties, and understanding how to make those assets work for you. In the next part, we'll talk about stocks and why the wealthy use them to compound their wealth. While real estate is an essential part of their strategy, stocks are just as crucial. If you're going to build lasting wealth, understanding the stock market is a must. Beloved listeners, now that we've explored real estate as one of the key vehicles the wealthy use to build wealth, let's move on to another critical asset, stocks. When you hear the term stocks, what comes to mind? Most people think of the stock market as a volatile place filled with risk and uncertainty. You've probably heard stories of people making huge gains in a short time, only to watch those gains disappear just as quickly. The stock market can indeed be risky, but it is also one of the most powerful ways to grow wealth. Why do the wealthiest people in the world consistently invest in the stock market despite its volatility? The answer is simple. Azure stocks offer growth potential that no other asset class can match. When you invest in stocks, you are essentially buying Oz ownership in a company. And if you choose wisely, that company can grow, generate profits, and provide you with a year's share of those profits in the form of dividends and capital appreciation. Over time, stocks have outperformed most other assets in terms of total return, and by a wide margin. But let's dive deeper into why this is so important. The wealthy don't just invest in any stock. They understand that consistent long-term growth is the key to wealth building. That's why they carefully choose companies with strong fundamentals, capable management teams, and significant growth potential. Take the example of companies like Azur's Apple, Amazon, or Berkshire Hathaway, names that many of you may recognize. These companies didn't become wealth-generating powerhouses overnight. They grew slowly but steadily, often taking years or even decades to reach their current positions. The early investors in these companies took a chance, but it paid off. They understood the long-term potential of these businesses, and they were patient. They didn't try to time the market. They didn't try to chase quick gains. They invested in quality companies with the vision that over time these companies would grow and their stock prices would rise in tandem. For instance, imagine you invested $1,000 Amazon 20 years ago in the year 2000. That investment would have been worth over $1,000 today, depending on when you sold. That's the power of Azur's compounding and the wealth-building potential that stocks offer. But let me be clear, this isn't about speculative trading or gambling. This is about understanding value, and investing for the long term. Stocks also provide a unique advantage in terms of liquidity. Unlike real estate, which can take months or even years to sell, stocks can be bought and sold quickly. This makes stocks a flexible asset, one that allows you to adjust your portfolio as needed based on changes in the market or your financial goals. You don't need to wait for a property to appreciate or for tenants to pay their rent. With stocks, you can sell a portion of your holdings when you need access to cash, giving you greater flexibility and control over your finances. But let's talk about the key difference between the wealthy and the average investor. The wealthy don't get distracted by short-term market fluctuations. They don't panic when the market drops by a few points. Instead, they focus on value investing, finding companies with strong potential and holding on to those stocks for the long term, often for decades. They understand compounding, which means they recognize the power of time in the market. Think about how Warren Buffett, the world's most successful investor, built his fortune. He didn't make his money by buying and selling stocks every day. No, he invested in businesses he believed in and held on to them. This strategy is what's called Azur's buy and hold investing. By holding his investments for decades, he has accumulated billions of dollars in wealth. One of the keys to wealth building through stocks is patience. The market may go up and down in the short term, but over the long term, high-quality companies tend to grow and their stock prices rise. This is why the wealthy focus on long-term investments and avoid the temptation of quick speculative trading. Moreover, stocks allow for the power of diversification. While real estate provides incredible wealth building opportunities, it's not always practical to invest in multiple properties, especially if you're just starting out. Stocks, on the other hand, allow you to invest in a wide variety of industries, companies, and markets with relatively small amounts of capital. By spreading your investments across multiple stocks, you reduce your risk and increase your chances of hitting on companies that will perform well over time. But as with any asset, it's important to approach stock investing with knowledge and strategy. The wealthy don't invest blindly. They do their research. They understand the companies they're investing in and have a clear sense of their long-term potential. They may not be able to predict the short-term movements of the stock market, but they have confidence in the businesses they've invested in. If you're new to investing in stocks, remember that it's not about getting rich overnight. It's about consistent growth over time. It's about making your money work for you, not just storing it in a bank account where it's losing value. Dear family of dreamers, Now that we've covered the stocks as a powerful wealth building tool, let's move on to another key asset class that the wealthy use to preserve and grow their wealth: these bonds. You may not hear as much about bonds in everyday discussions of wealth building. People often focus on the flashier, higher risk assets like stocks or real estate, but bonds have an undeniable ours role in the portfolios of the world's wealthiest individuals. In fact, ours bonds are the cornerstone of a well-rounded investment strategies. They provide a safe, stable income stream, reduce overall portfolio risk, and act as a vast counterbalance to the volatility of stocks. Let's begin with the fundamentals. At their core, bonds are as debt securities. When you buy a bond, you are essentially lending your money to a government, corporation, or other entity for a fixed period. In return, the issuer of the bond promises to pay you at these regular interest payments, and at the end of the bond's term, they will repay you the each principal, the amount you invested. This is a relatively safe investment compared to stocks because you're not relying on the performance of a company to generate returns. Instead, you're relying on the issuer's ability to repay the debt, and in most cases, governments and large corporations have the means to do so. Now, you might be thinking, if bonds are so safe, why are they a key part of the wealth building strategy for the rich? The answer is simple. Bonds help the wealthy achieve balance and stability in their portfolios. While stocks offer high growth potential, they also carry risk. Bonds, on the other hand, offers predictable returns with far less volatility. This stability is crucial, especially when you're managing as large sums of wealth. Think of it this way. When you invest heavily in stocks, the value of your portfolio can fluctuate significantly based on market conditions. One day your stock portfolio might be up 10%, and the next day it could drop by 5%. While this volatility can lead to big gains, it can also lead to big losses, especially if you're relying on your portfolio for consistent cash flow. Bonds, however, provide a steady income through interest payments. For instance, if you invest in a bond that pays 5% annually, you can expect to receive a predictable income stream, regardless of how the stock market is performing. This creates a stable cash flow for the wealthy, which they can use for a variety of purposes, whether it's reinvesting the returns, buying more assets, or enjoying the fruits of their labor. But the real beauty of bonds lies in their ability to reduce portfolio risk. The wealthy understand that in order to create lasting wealth, they must diversify across multiple asset classes. Bonds play a crucial role in this diversification strategy. When the stock market is struggling, bonds often perform better, helping to offset any losses from stocks. This balancing act is one of the reasons why bonds are such a vital part of any comprehensive wealth building strategy. Let's take a look at the role bonds have played in the wealth of the rich over the years. Imagine someone who has invested in a balanced portfolio consisting of both stocks and bonds. When the stock market takes a downturn, the bond portion of their portfolio helps to cushion the blow, maintaining a more consistent value. This means the wealthy are not as emotionally affected by market fluctuations in the same way others might be. Their wealth continues to grow steadily over time, thanks to the predictable nature of bonds. One example of this is the way billionaires use bonds to preserve and grow their wealth. Take Ray Dalio, one of the most successful hedge fund managers in history. His investment strategy includes a diversified portfolio that consists of stocks, bonds, and commodities. The bond portion of his portfolio acts as a stabilizing force, ensuring that he has a very steady flow of income, regardless of how the stock market is performing. But you don't need billions of dollars to take advantage of bonds. Anyone can invest in bonds through bond mutual funds or exchange-traded funds, which provide access to a diversified portfolio of bonds. These funds allow you to participate in the bond market without needing to buy individual bonds, which can sometimes be out of reach for smaller investors. Another great advantage of bonds is that they are an excellent hedge against inflation. As inflation rises, the price of goods and services increases, but the fixed interest payments from bonds stay the same. This means that bonds can help preserve your purchasing power during times of inflation, providing a stable income in an unstable economy. However, not all bonds are created equal. The wealthy don't just buy any bond, they carefully select high-quality bonds with strong credit ratings. The lower the credit rating, the higher the risk that the issuer might default on the bond. The wealthy, who understand the importance of preserving wealth, generally prefer government bonds or high-grade corporate bonds to ensure that their investments are secure. One of the most important lessons when it comes to bonds is the concept of diversification. The wealthy don't put all their money in one type of bond or in one asset class. They understand the importance of balancing their portfolios across multiple investments, which is why they hold a vast mix of bonds, stocks, real estate, and alternative investment stars. By doing this, they can ensure that their wealth is not overly reliant on any one asset, reducing the potential for large losses. Dear family of dreamers, as we venture deeper into the world of wealth building, let's explore the next asset class that the wealthy use to amplify their fortunes, emphasizing alternative investments. When most people think of investing, they immediately think of as stocks, as bond, or real estate. These are the traditional vehicles of wealth creation, and for good reason. But the as wealthy know that to truly grow their wealth, they must go beyond these conventional assets. They understand that the heir's secret to extraordinary wealth often lies in his alternative investments, investments that are not part of the traditional asset classes. So, what exactly are ours alternative investments? These are assets that fall outside the usual stock, bond, and real estate categories. They can include things like a private equity, as commodities, as cryptocurrency, ours are to collectibles, and even ours are venture capital. Let's break this down a little bit further. 5 is private equity. One of the most powerful alternative investments the wealthy make is private equity. Private equity involves investing in private companies that are not publicly traded on the stock market. These investments typically require significant capital, as private equity firms often need to buy entire businesses or large stakes in them. But why do the wealthy invest in private equity? The reason is that private companies often have higher growth potential than public companies. As a private investor, you're able to enter at an earlier stage, often before a company has reached its full potential. And when the company grows, you can reap huge rewards. Take as venture capital as an example, a subset of private equity. When early stage startups receive funding, they often offer as higher risky, but as significantly higher reward. Many of the wealthiest individuals in the world, including Mark Zuckerberg and Elon Musk, have made their fortunes by investing in early-stage startups that later grew into multi-billion-dollar companies. These are the types of investments that make people rich beyond their wildest dreams. Ours hedge funds. Another key alternative investment the wealthy often rely on is hedge funds. Hedge funds are private investment funds that use a variety of strategies, including short selling as leveraged investments and as derivatives to generate returns. Unlike mutual funds, hedge funds are typically open only to accredited investors, which means you need to meet specific wealth or income requirements to invest. Hedge funds are known for their ability to generate returns in all market conditions, including downturns. This makes them an attractive option for the wealthy who seek to protect their wealth from market volatility. By investing in hedge funds, the rich are able to access specialized strategies and expert management that help them grow their wealth while minimizing risk. Commodities. Next up are commodities, assets like gold, silver, oil, and agriculture that are traded in global markets. Commodities are a unique investment because they tend to perform well when traditional assets like stocks and bonds are underperforming. For example, during times of economic uncertainty or inflation, the price of gold often rises as people look for a safe haven for their money. Similarly, oil's prices tend to rise when there are disruptions in the global supply chain or geopolitical instability. The wealthy use commodities as a way to hedge against economic risk and diversify their portfolios. But what's even more fascinating about commodities is the ability to invest in them through futures contracts, agreements to buy or sell a commodity at a future date at a predetermined price. This allows the wealthy to profit from price fluctuations in the market, often without having to physically own the underlying asset. Cryptocurrency. One of the newer and more exciting alternative investments is cryptocurrency. While cryptocurrencies like Bitcoin, others Ethereum, and others have gained significant attention in recent years, They are still relatively new and highly volatile. But the wealthy understand that early-stage investments can sometimes lead to massive gains. Let me be clear, as cryptocurrencies are not for everyone. They are speculative and highly risky, and many people have lost a great deal of money investing in them. However, for those who understand the technology and the potential behind it, cryptocurrencies can offer huge returns. The wealthy often have access to expert insights and strategies that allow them to navigate this complex and volatile space with a greater chance of success. Focus art and collectibles. Finally, let's talk about Abersar's art and collectibles. These are some of the most unconventional alternative investments, but they have made many wealthy individuals even richer over the years. Investing in rare art, as vintage cars, wines, and other collectibles has been a tried and true strategy for the ultra-wealthy. Why? Because these assets tend to appreciate in value over time, often outperforming traditional investments. For example, a Picasso painting, bought decades ago for a few $1,000s, could now be worth as millions. A rare vintage car bought by a collector could appreciate exponentially in value as time goes on. The wealthy understand that these types of assets offer both emotional value and financial gain. They have the potential to be passed down to future generations, providing long-term wealth and legacy. Why quickly is the key to wealth? What's the key takeaway from all of this? It's simple. The wealthy don't rely on traditional investments alone. They understand that to achieve extraordinary wealth, they must invest in a diverse set of assets, some of which may seem unconventional to the average investor. Alternative investments are the key to creating long-term sustainable wealth. But they're not for everyone. The wealthy invest in these assets because they have the knowledge, resources, and experiences to manage the risks involved. Dear family of dreamers, as we continue our journey into the realm of alternative investments, we now arrive at an asset class that has stood the test of time, precious metals. Specifically, silver and other precious metals. For centuries, the wealthy have used these assets to preserve wealth, hedge against inflation, and to protect against economic uncertainty. You see, precious metals are not just an investment vehicle. They are a store of value. While paper currencies come and go, metals like gold have retained their value for thousands of years. This longevity, this inherent ability to withstand the test of time, is precisely why the rich keep precious metals in their portfolios. Let's break down why precious metals are so crucial for wealth preservation. What is gold? The ultimate safe haven, gold has been revered as the ultimate store of wealth for millennia. When the world faces economic turmoil, inflation, or political instability, people flock to gold. It has been the go-to asset during times of crisis, and there's a reason why central banks, as well as individual investors, keep it as part of their portfolios. Why is gold so special? Well, gold has a limited supply. Unlike fiat currencies, which can be printed at will by governments, gold cannot be manufactured, and its supply is constrained by the natural resources that exist in the world. This scarcity gives it intrinsic value. As governments print more money and creates debtors, the value of currencies can erode. But as gold, being finite, retains its purchasing powers over time. We've seen this play out in history. Take, for instance, the global financial crisis of 2008. During that time, gold prices soared as investors feared the collapse of the banking system and inflation eroding the value of their paper assets. As banks printed more money to stimulate the economy, the value of fiat currency began to decline. But gold stood strong, as timeless hedge against the economic chaos. Wealthy individuals and institutions recognize this. They don't panics when times get tough. Instead, they flock to gold to protect their wealth. This is why central banks around the world hold gold in their reserves. It is the ZIR's ultimate hedge against currency devaluation and inflation. And if it's good enough for the world's most powerful institutions, it should be good enough for you. Silver, the underrated companion. While gold is often the star of the precious metals world, our silver plays a vital role too. Silver is often seen as the more affordable alternative to gold, but don't let that fool you. Silver is just as powerful, if not more so in certain circumstances. Silver has industrial uses, which give it an added dimension that gold doesn't have. From as electronics to solar panels, silver is a key component in many modern technologies. This demand for silver in as industrial applications ensures that its value remains fast steady, even when the economy is not booming. But when times of as economic uncertainty arise, silver's value can soar just as gold does. For the wealthy, silver offers the same as benefits as gold, but with more as volatility. This can lead to greater opportunity for profit when silver prices spike. It's important to understand, though, that silver's value can fluctuate more than gold's. So the wealthy use silver in a vast balance as manner as part of a diversified approach to preserving and growing their wealth. 5. Diversification within precious metals. Now, as you're considering gold and silver, it's important to remember that the wealthy don't put all their eggs in one basket. They diversify within precious metals, ensuring that they hold both as gold and as or silver in their portfolios. Some may also invest in as platinum or as palladium, other precious metals that play their own roles in the global economy. But why is this diversification within precious metals so critical? Because the zuzer's value of gold and silver may not always move in the same direction. For instance, during times of economic crisis, gold might perform incredibly well, but silver could experience a period of price-fast correction. However, if silver is used in industrial applications and the economy recovers, its price might surge faster than gold. The wealthy understand that holding ours both gives them the opportunity to capitalize on different market conditions and maximize their returns while maintaining ours or safe haven ours against uncertainty. 5 years are how the wealthy utilize precious metals. The wealthy don't just buy gold and silver and store them under their mattresses. They invest in precious metals in a strategic way. They might purchase gold-backed ETFs or silver mining stocks to gain exposure to the precious metals markets without actually holding the physical metal. Alternatively, they might buy physical gold and silver coins as bars or as bullions, holding them as tangible assets that can be sold in the future. Additionally, precious metals are used as part of a larger wealth protection strategy. Many wealthy individuals incorporate gold and silver into their estate planning, ensuring that these assets are passed down to future generations. By holding precious metals, they can ensure that their wealth is protected against economic instability, and that it will continue to grow for generations to come. But precious metals aren't just about preservation. They're also about profit. The wealthy know that when the value of gold or silver rises, it can bring substantial returns. And in times of global financial instability, they often position themselves to profit from these rising prices, adding to their already substantial wealth. Beloved listeners, we've traversed the world of VO's alternative investments, precious metals, and unconventional assets, and now we arrive at perhaps the era's most reliable and powerful asset class of all eras, real estate. It's the one investment that has weathered the storms of history and still stands as the cornerstone of wealth for the richest individuals in the world. Real estate is not just a way to build wealth, it's a way to secure it, expand it, and pass it on for generations to come. Real estate has been the foundation of generational wealth for centuries, and for good reason. It's an asset that offers stability, predictable returns, and appreciation over time. But the wealthy do not treat real estate as mere property to live in or buy and hold for the long term. No, they leverage real estate to create massive cash flow tax advantages and long-term capital appreciation. 5 R's the power of leverage in real estate. One of the most significant advantages real estate offers the wealthy is leverage. You see, when you buy real estate, you don't need to pay the full price up front. Instead, you can borrow money from a bank or a lender using your property as collateral. This concept of leverage allows you to control a much larger asset than you could afford if you had to pay for it in full. Let me give you an example. Let's say you're buying a property worth $500. Instead of paying the entire amount up front, you might put down 20% down payment, or here's $100. And you then borrow the remaining $400 from a lender. Now you're controlling a $500 asset with just $100 of your own money. Now, here's where it gets interesting. When the property appreciates in value, let's say it increases by 1,000% in 5 years, now the property is worth $550,000. You've just gained $50,000 profit, but you've only invested as $100,000 of your own money. That's a 50% return on investment. This is the beauty of leverage. The ability to control as or much more value than you could afford to purchase outright, while ours are locking in profits as the property appreciates. But that's not all. Real estate provides consistent cash flow through rental income, which is another powerful way to build wealth. PAVE's rental income and cash flows. Let's talk about the power of ours cash flow. Real estate is one of the few asset classes that can generate consistent monthly income. When you buy a rental property, you're not just betting on the property's future value appreciation, you're betting on its ability to generate ongoing revenue through rent. For example, let's say you own a property that rents for $2,000 per month. Over the course of a year, that's our $24,000 in income. And depending on how much you've leveraged the property, that a rental income can be used to cover the OZ mortgage and generate a RAL's profit on top of it. As the years go by, your OZ loan balance decreases as tenants pay the rent and your property's value increases. This vast combination of cash flow and property appreciation makes real estate one of the most predictable and stable ways to grow wealth over time. But let's not forget that there's tax advantages that come with owning real estate. Real estate investors have access to tax deductions and benefits that help maximize returns and preserve wealth. Hi-Fi covers the tax benefits of real estate. One of the key reasons why the wealthy invest in real estate is the source tax advantages it offers. Real estate investors can take advantage of several tax breaks that make it a more favorable investment compared to other asset classes. The most powerful of these tax benefits is Sears depreciation. You see, the IRS allows property owners to depreciate their real estate holdings over a period of time, even though the property is likely appreciating in value. This means you can write off a portion of the property's value each year as an expense, lowering your taxable income. This allows you to pay less in taxes while still benefiting from property appreciation. Additionally, real estate investors can deduct expenses related to the property, such as repairs, maintenance, and property taxes, and mortgage interest. These tax breaks make real estate an incredibly efficient way to build wealth while paying fewer taxes. Real estate for long-term wealth building. Real estate is the ultimate long-term wealth building tool because it offers a combination of capital appreciation, cash flow, tax advantages, and leverage. It's an asset that continues to appreciate in value over time, especially when you hold it over the long haul. But it's not just about buying a property and letting it sit. The wealthy strategically invest in real estate. They leverage it, maximize cash flow, and use tax benefits to preserve wealth. They know that by strategically buying, improving, and renting or flipping properties, they can create multiple streams of income, while also benefiting from long-term wealth appreciation. In fact, many of the wealthiest individuals in the world, including Warren Buffett and Sam Zell, have built their fortunes through real estate investments. They understand that the combination of reliable income appreciation and leverages makes real estate one of the most stable and profitable asset classes available. Hopeless is the millionaire mindset with real estate. The key takeaway here is this: real estate is not get-rich-quick strategy, but it is a wealth building strategy. The wealthy do not invest in real estate expecting to see overnight results. Instead, they understand that real estate requires patience, strategic planning, and a long-term vision. But with that vision comes incredible of rewards. Real estate has the power to transform your financial future. It's a tool that can stabilize your wealth, protect you from inflation, and provide reliable cash flow for years to come. For those who are willing to learn the ropes, take calculated risks, and invest wisely, real estate can be the foundation of generational wealth, too. As we conclude this journey through 7 incredible assets that the wealthy use to create and protect their wealth, remember that diversification is key. By combining precious metals, real estate, alternative investments, and the other assets we've discussed, you will be better equipped to build and safeguard your wealth in the years ahead. The wealthiest people in the world don't rely on one asset class to make their fortune. They strategically allocated their resources, and so should you. When you master the art of investing And when you build a diverse portfolio that includes these powerful assets, you'll be well on your way to financial success. Thank you for being part of this journey. If you have any questions or want to dive deeper into any of these concepts, don't hesitate to reach out. The future is yours to shape.